If you've grown up hearing that investing in the stock market is risky or that it's gambling, I'm here to tell you that that advice is wrong and it's actually downright dangerous. Now, in this video, I'm going to walk you through step by step how to invest, how to open a brokerage account, what to look for stocks, and I'm going to show my screen and show you exactly what I would invest in if I were just starting. Now, as a disclaimer, I am not a financial advisor. I am not a tax professional, so you'll have to consult your own professionals. I'm just going to show you what I would do if I were just starting. And what does any of this have to do with chocolate cake? We're going to get into that and more, and we're starting right now. The people that are telling you that investing is risky or it's gambling, number one, probably haven't been taught how to invest wisely. And number two, they probably aren't even investing themselves. To be completely honest, investing in the stock market can be risky and it can be a gamble if you don't know what you're doing. When you invest in a stock, you become part owner of that company. So it's really important that you're doing your research and you're doing your due diligence for a company that you know, like, and trust before you even purchase anything. You definitely should not be investing in something that you don't understand. You definitely need to gain your own financial education, do your own research to become a savvy and smart investor. And you shouldn't go around just blindly listening to random people on the internet. Yes, like me. In the auditing world, we have this saying called trust but verify. You do want to trust the things that you're hearing, but at the same time, you want to verify the things that you're hearing are truthful and make sense for you. There's so many factors that go into building wealth, and for investing, one of those factors is time. Now, if you're starting late, if you're a late bloomer, don't worry, you have plenty of time to get yourself into the market and start building wealth so that you can retire and not have to worry so much about how you're going to fund yourself in retirement when you can no longer work. Building wealth through investing, you can do this a couple ways, and you can buy and hold stocks, which is what I would recommend, and just keep them for the long term, let them appreciate in value. And what appreciation means is that if you buy a stock today, in 5 years from now and 10 years from now and 30 years from now, that stock should be worth more than it is today. The other way you can build wealth through investing is through dividends. So companies will pay you just to hold that stock. So there's a bunch of different companies out there that will pay you a dividend, which is almost like an interest payment in a way, if you want to think about it like that. If you get interest on your savings account or on your checking account, it's kind of the same thing. You get a little bit of money for whatever stock that you own if that company pays dividends. So how nice is that? You're just sitting at home doing nothing, and then your phone dings and you've got a dividend payment. So I am promising you that investing is not as scary as a lot of people make it sound. This video is going to simplify the whole process. I'm going to show you how to start an account and what to look at. But first, I do want to go over a couple of things so that you fully understand what it is that I'm about to show you when we go and walk through my screen. I don't want to just get to my screen and have you blindly just not know what you're looking at. So let's start with that first. Just a little bit about my background. I have been in the markets for about 13 years now. I did start in my mid-20s, but I might have been in that same situation that you were back then. And the reason why you're not invested in the markets today is because someone might have told you, oh, just get yourself started and put $10,000 in, and by the time you retire, you'll be a millionaire. And it's like, okay, well, that's great. What do I do now? Where do I go? What do I invest in? What am I going to be safe? And am I going to lose all my money? I have no idea. And I was maybe 18 at the time, and I was just starting school and trying to just get a job. And I had no idea what I was doing at the time. Even if you're watching this and you're in your late 30s, 40s, 50s, you still have some time, and it's going to be worth it to get yourself into the stock market and get yourself investing so you can fund yourself a little bit more in retirement. There's that saying, how did it go? The best time to plant a tree was 20 years ago. The second best time to plant a tree is today. So that day is today. You're going to start planting your investment trees as soon as this video is done, right? The very first step that you need is a brokerage company, and a brokerage company is just a middleman that helps connect the sellers with the buyers for investments. There are so many brokerages, and let me hop on Google really quickly and I'll just show you. I'm here right now and I just Googled best investment brokers for beginners, and you can see there's a lot of them. There's E-Trade. You can look for, like, here's NerdWallet 11 best online stock brokers for beginners. And this will, and it's pretty updated, August 3rd, 2022. And it'll just give you this list. So there's Fidelity, Merrill, Vanguard, E-Trade. There's so many, and you can really just pick whatever one you want. Here's Robinhood, Ally, Webull. These two are pretty popular. These are the ones I hear about a lot in ads and things like that. So you just want to pick whatever works best for you. It doesn't really matter which one you pick. Just look at a couple of these brokers and see which one you like the best. Some have really good online platforms, some have really good mobile platforms. You just pick whichever one you want to invest in. The stock I'm going to actually walk you through and what I'm going to recommend and what I would have wanted to have recommended to me when I was younger is an index fund. And I'll go over exactly what that is. And so there's index funds that you can invest in as a beginner, which kind of take a whole bunch of companies and they put them into one stock that you can buy. And so you're kind of spread up out across a bunch of different companies all in one stock. And that's really an easy way to get yourself into the market without having to be invested in a single company. Single company investments are a lot riskier, and they're not, to me, they're not super risky if you know the company and you like them and you trust them and going to stay on top of the research to keep updated on if they're doing well or not financially. But if you're investing in a single company, there's so many things that could affect that company financially that could cause that stock to go down. And it could be anything from shipping delays to problems with consumers to negative reports. Anything can really happen to cause that company stock to go down. And so as a beginner, I would rather be invested in a gigantic pool of companies versus just one. So I'm spreading my risk out that way. I am pretty risk averse, and this is something that I should have done when I first started investing. And so that's what this is for. So let's get into what an index fund is. There's three main indexes that the United States really uses to kind of gauge how the economy is doing. And that's the Standard & Poor's 500, which is a list of 500 big companies in the United States. There's the Dow Jones Industrial Average, and they have 30 of the biggest companies in the United States. And then there's the NASDAQ Composite, and they have a whopping 3,700 companies on their list. Now, let's talk about the chocolate cake. So when I talk about an index, I'm thinking of an index as like the recipe card for the chocolate cake. Like there's a list of recipes, a list of ingredients on this recipe card to make chocolate cake. Now, I can't buy the chocolate cake. I can't do anything with the chocolate cake. I can just look at the recipe. That's what the index is. It's just a list. So you're like, well, wait a minute. I want to eat the chocolate cake. How do we get to the chocolate cake? It smells so good. Now, the index is just a list of these companies. It's not the actual investment. So you need a fund to be able to invest in those big companies. So if I were to think of an index fund like a chocolate cake, the recipe card would be my index. So the recipe card for German chocolate cake, for example, would be the Standard & Poor's 500. It's just the list. It just tells me what it's made out of, and that's it. I can't do anything else with it. Now, for the investment fund itself, there are quite a few of them, and those are the ingredients. Those are the different actual physical ingredients that make up that recipe for that chocolate cake. So if I were going to go to the grocery store or go to my brokerage account and buy those ingredients, then I would be able to make my chocolate cake or be able to buy that fund. So my chocolate cake recipe is the index fund for the S&P 500, and I'll show you which one I really like. Hopefully that made sense. I was trying to come up with a really simple, easy idea on how an index fund worked because I had gotten confused about that in the past and I really wasn't sure how that worked. So hopefully that made sense. I mean, if it didn't, you can definitely rant about it in the comments below. That's totally fine with me. I'm gonna go eat my index fund now. So good. Okay, I recorded this earlier and I didn't have a voiceover, so I'm going to play this for you now and walk you through step by step. So I chose SoFi as the investing investing app here on my phone. You can see there's Webull right below. You can choose whatever brokerage you want. I just chose SoFi, and you just open it up and you get started. The very first thing that it's going to ask you to do is it's going to ask you to input your information here. So you just fill out your first name, last name, the state you live in, your email address, and your password. And then you have to check this box saying that you understand what you're signing to for, and then you click next. So we'll do that real quick and then I'll be right back. This is a really interesting feature. So as soon as you put in your information, it's going to ask you if you want to enable biometrics, and you can do that or you can choose not to. I just chose not right now. Okay, and now we're at the screen where they do a bunch of different things. There's banking, credit cards, investing, tracking your finances, credit score, and loans. So I'm just going to click on investing, and it looks like they have a promotion going on right now where you can start trading for $1 and you can win up to $1,000. So that's pretty cool. Let's click into that. All right, so you can start investing or you can keep exploring, but let's click on start investing. Okay, so you can trade crypto, you can trade stocks and ETFs only, you can have SoFi build a portfolio for you, or you can invest for your retirement. So they'll ask you a bunch of different things that you can choose, and you can decide what you want to do. Okay. It's going to ask you for your permanent address. So let's put that in, and I will be right back. Okay, the next thing it's going to do is it's going to ask you what your employment status is. Are you employed full-time, part-time, self-employed, not currently employed, or retired? And then it's going to ask you who your employer is, and you can put in an address if you want. I'm not going to do that. I'm just going to put in my employer name and move on to the next screen. Next, it's asking what your occupation is. I just put in accountant, easy. And then it asks you to put your annual income in so that they can know your customer. Oh, that's what it says, know our customers. And then it asks, what is your citizenship status? Are you a U.S. citizen? Are you a green card holder? Are you a non-permanent resident alien? I'm a U.S. citizen, so I'm going to click on that one. And it then asks you what your date of birth is. And finally, what your social security number is. Now, this is encrypted, so it is safe, and they do not do a credit check on you, so it's not going to affect your credit score. It's just standard opening account procedures. All right, so now you put in your phone number, and you're going to get a text message, and that's going to help you verify your account so that you can open it and get started. Okay, so I got the verification code. There it is. I'm going to enter that in right now, and we are going to get started. It's as easy as that. All right, once you're in your account, no, it doesn't let me screen record everything for privacy reasons. It's just not letting me screen record everything, but you can connect your bank accounts to this, and it's pretty easy. Here it's telling you that it uses Plaid, and you can put in what your financial institution is, and then authenticate, and then it'll link your accounts. Okay, so I didn't put any money into this, but, and it didn't let me show everything. So I'm here at the point where now I'm logged back in, and you can see I haven't put any money in. So it has $0, but look, I can invest in Bitcoin, Ethereum, and there's these cool, like, little learn. How do I use a dividend reinvestment? How do I order? My brother was messaging me. I just thought this is really cool. Look, VOOs down there, Dow Jones, the NASDAQ, the S&P 500. If I click into this Investing 101, this is really cool. This is super cool. So if you weren't sure what to invest in or how to invest, you can do that. And then this is the watch list. I was so excited to see this. If I want to invest in Tesla and Apple and SoFi and Vanguard, I can just add all these to my watch list. And then I can watch these stocks and monitor these stocks. It's really cool. You can put anything that you want in here. So I just scrolled through and added a bunch of random things that I thought was interesting. And then now look, I can watch these and see what they do over time. And then if I'm ready to buy, I can just swipe on it and buy. Very cool. I just really like this feature. I love the watch list. It's super exciting to me just to kind of see what all of my interests are doing at any given point in time. Look, okay, here's Apple. This is what Apple's doing over today. It's one day, 1 week. More volatile. Oh, interesting. Okay. Just tells you it's a little bit more volatile now. Really cool. I just really like this feature. Here's the Vanguard S&P 500. This is what it's doing. This is what it costs. Here's the top 10 holdings there. There you go. Apple's the #1 holding. I just love this feature. I think it's really cool. And I'm going to go over this stock in a lot more detail. But that's basically to get you started. You can do this on your phone. You can do this on your laptop. It doesn't really matter what you pick or what you choose. I just wanted to show you how easy it was to start a new account. So whatever you're interested in looking into and doing, just get yourself started. You don't need a lot of information. You just need your personal information, and you can open an account, link it to your bank account, and you go investing today. I just want to take a moment and tell you how much I'm so proud of you for taking these little baby steps to get yourself to a better financial place. The moment you've all been waiting for, let's look at my screen, and I'm going to show you exactly how to do all of this. All right, this is the moment we've been waiting for. We're here in my portfolio. This is one of my brokerages that I have. I have E-Trade, and I have that for a specific reason. You can pick whatever brokerage you want. You do not have to pick E-Trade. This is just easy for me to jump on and show you because I've had this for the longest. You can see up at the top, it's really cool. It shows you the 3 index that we talked about. Here's the Dow Jones, the NASDAQ Composite, and the S&P 500. And you can just kind of see what they're doing at a quick little snapshot. Dow Jones is up. They only have the 30 companies. This one has all the companies, and this one has just 500. So you can see what a difference it makes here. The markets are closed. So I'm here on the West Coast, and the stock exchanges are all on the East Coast. So, of course, they're closed here. This is a really exciting place to be. This is my watch list, and I've tailored this specifically for this video, and it's really exciting. Doesn't matter what brokerage you pick. You can start getting really excited and start watching companies. If you're not quite sure you're ready to buy or you want to do some more research on them, you can put them into a watch list, and every brokerage has this option. I tested it on a couple of my other ones. So these are the 3 index funds that I wanted to show you here, and I'll show you the ones that I recommend. This is the one that if I were just starting again from the beginning as a beginner, this is what I would put my money into, is this VOO, Vanguard S&P 500 Exchange Traded Fund, which just means it's exchanged on the stock market. So it's an exchange traded fund. And you can see, look at the prices are pretty close. These 2 are actually closer. They're the same exact thing, and I'll show you in a minute. And you can see here's the price that it was when the market closed. This was the price when I added it in June 2022. So I added this a couple months ago when I first started my channel. And look at the difference already. Look at how much it's grown since I first put it in. Now, this is just a couple of months. This is very short term. So this has probably been cheaper when it was first put into play here. So look at that, 9% growth. I'm going to get into this later, and the reason why I am highly recommending that anybody that is planning to retire ever, they need to be in the stock market. You guys need to be in the stock market. And this is why. You cannot get appreciation like this outside of the stock market for a longer term, because inflation's going to eat at it. And I'll go into that in a minute. I don't want to confuse you guys here, but this has just been a couple short months here, and it's already up 9%. So this is the stock that I want to go into. And I want to say, don't let the price of this deter you or make you feel like you can never purchase this. This can take you some time to save up. Now, this takes me some time to save up. I don't always have an extra $400 every paycheck to put into
to buying stocks, but this is what I would say would be aspirational. This is what I would say to work up to, and put in as much or as little as you can. Put in as much as you can, even if it's just a little bit. So this is $379.98. So I would say put in a little bit more than that, just in case the price goes up at the time that the purchase order goes through. So you have enough money and it doesn't get, it doesn't get denied. So, okay, so this is the Vanguard S&P 500 exchange traded fund. Now, don't let this make you crazy. I only concentrate on a couple of things. I don't even worry about any of this stuff on the left-hand side of the screen here, okay? So you have charts that you can look at, news, all of these things, performance, tax, and income. I don't look at any of these. I mean, if you want to do more research, this is where it is. This is where you can come and actually research the actual index fund here. Okay, this is the expense ratio. This tells you how expensive it is for this fund to be maintained. Now, on the more expensive side, it would be over like 1% here. This is very, very, very small potatoes. This is probably one of the most affordable, cheapest expense ratios that I've seen. And that just means it's not actively managed. It's running through a computer. There's nobody on the back end, making sure everything is going well, computer-wise, system-wise. Nobody has to manage this fund actively. No one is actively buying things or selling things. You buy it once, you set it, you forget it, right? So net expense ratio. So this tells me, let's do this per 1,000. So I need to change this percentage to a decimal. So I'm going to take 0.03% and I'm going to divide it by 100 and get a decimal. And then what I'm going to do is I'm going to multiply this by 1,000 because we want to compare, apples to apples here because we're going to do this with a couple of funds. So this is costing you 30 cents. It's 0.3 and the zero isn't there, but it's 30 cents for every $1,000 that you have in this fund. If you buy $1,000, it's going to cost you 30 cents. So you don't want to have a stock or an index fund that's costing you a lot of money. So for example, if we got a stock that was a 1.25%, so if this was 1.25%, and that meant, there was a lot of hands touching this and a lot of things going on that had to be actively managed. So we're going to divide this by 100. And that's going to give us our decimal. And then we're going to multiply that by 1,000. Just hypothetically speaking, if we had a stock with a higher expense ratio that was a little bit more expensive, what would that cost us every year? And it would cost us $12.50 every year if we had $1,000 in whatever this hypothetical stock would be. That would cost us a 1.25%. So you can see it's a huge difference between $12.50 and 30 cents here. Okay, so let's move on to the quarterly dividend. This is really exciting because not only do you get to have this index fund and have a whole bunch of companies in this one purchase, you also get paid dividends, quarterly dividends. Now this is not very high, right? It's a very low risk index fund. You're not taking a lot of risk to have to be holding this. So, and you're kind of compensated for that with this lower rate. But that's kind of awesome. You're kind of getting two methods of wealth growth because this may grow over time. Essentially, that's what it's historically done, is it's grown about 10% historically since inception. And it's telling you that you get 1.48% or $1.43 every quarter. So let's see how much we get for the whole year here. $1.43, and we're going to multiply that by 4 because it's 4 quarters. So for the year, you're going to get paid $5.72 for having one stock. For one of these stocks, you're going to get $5.72. Now, if you have more stock, let's say you hold 3 stock, you're going to get $17.16 for the whole year, okay? Not a lot of money, but it's still something. And I'll tell you what to do with this in a minute. We'll get into that in a bit. You can see the last dividend was issued or declared on June 29th, 2022, and it was paid out on July 5th. That's it. That's all I look at. What is the expense ratio? Does it pay dividends? If it does, how much? And the reason why this dollar amount is low too is that you're only getting $1.43 every quarter, but you have to pay $379.98 to get this $1 every quarter, this $1.43 every quarter. So this ratio is pretty low because you have to put in so much more money just to get a couple of bucks. So I'll show you a comparison in a minute. All right. I love to look at this kind of chart. This shows me the historical trend, and look what it's doing. I mean, I don't even have to tell you. It's just going up and up and up and up and up, okay? Now we see this drop, and what do you think caused this drop? You can see it was February 2020, and that's when the pandemic happened. And so everybody got really scared, and a lot of people pulled their money out of the market, and a lot of confidence had gone down, and a lot of people were scared, and companies were, forced to close. And so that's why the stock market went down then. But then look what happened. Look what happened. It just went up and up and up and up during a pandemic. So here we go. We're going down again. And what's going on in the economy is that we're heading towards a recession, or we're technically in a recession by definition. And so people are starting to get nervous again. But look at this increase from the first down trend and then this next downtrend. Look how fast it went up. It went from $247 and it went up to $430 at the highest here. How crazy is that in just a year, a little over a year, about a year and a half? This is what I mean by when wealthy people are investing and growing. If you had bought when everybody was selling, look at this, $247 per share in February. If you had bought, and you can't time the market, so that's not what I'm trying to explain here, but just giving you an idea of why I think it's so important to keep staying in the market, buying when everybody is selling. A lot of people made a lot of money from this $247. If they had sold right here at $430, they essentially doubled their money. They doubled their money. They bought it at $240. If they sold it at $430, which is nearly double what they paid for it, they essentially took $1 and made $2, is what they did. How incredible is that? So you can't do that with a savings account. You're just not going to be able to beat inflation. You're not going to be able to beat the growth. There's no value with keeping your money in a savings account if you're trying to save for retirement. That's not where it belongs. So here it's telling you this is a large blend, which means it's a bunch of large companies. It's all the 500 companies here, 500 largest companies. It measures the Standard & Poor's 500 index. We know that, right? And it was put into place in 2010. So we only have about 12 years of data for this investment fund, but it follows the Standard & Poor's index. So had it been available all those years ago and Standard & Poor's index came into the picture, we would have had pretty much almost the same data, and I'll show you what I mean by that in a second. Top 10 holdings. This is fascinating. So there's a circle here, and 30%, you can see it takes up almost 1/4 here of the entire circle. These are the top 10 companies. You can see it's all color coded by the highest amount of concentration that they have to the lowest. And then the rest are just filled up with a bunch of the other rest of the companies. So the top 10 companies make up 26.79% of this index fund. And we have Apple. You recognize this. It's still a small percentage. Look at that. It's only almost 7% of this index fund is Apple stock. So you're going to own, with one fund, you're going to own 7% of Apple stock, okay? Then we have Microsoft, Amazon. There's two classes of Google stock here, and they just mean different things. I won't go into it. There's Tesla, Berkshire Hathaway, United Health Group, Johnson & Johnson. You know all of these. Like, I think of the baby products. And then NVIDIA. And these are the top 10 companies that they have in this fund. So they're all recognizable. You know what a lot of these are. And this is the market value. And just looking at this is what gets me excited. I'm excited to invest in something. And I know they have this disclaimer here that says past performance and is no guarantee of future results, of course. What they do is they take the prior trends over a certain amount of time and they project it out. So it's projected to go up 10% in 3 years, and then 11% in 5 years, and then 12% in 10 years. Now, it's not a crazy growing stock. It's not going to make a ton of money, but it's very stable and it's very secure, and it's a safer, less risky investment because you're spread out amongst all of these different companies here. Now, I don't really pay attention to this, and I'll show you why. Let's look at another stock here. That's VOO. That's Vanguard. So let's look at another one, another S&P 500 index stock. And let's look at this SPDR because this one has some differences, and I want to show you in comparison. Because the more you look at these stocks and index funds, the more you're going to be comfortable and you're going to start to recognize things and go, you know, I actually can invest, and I do feel a lot more comfortable. So again, this is SPY. That is the ticker symbol. That's what you do when you need to look something up. You would look up, you can actually type in like Disney, and it'll show you DIS is the ticker symbol. So if we look up SPY, there you can see it shows up right there, okay? So it's pretty simple. Okay, so this is another S&P 500 index fund. Now I want to show you these. Look at this. It's the exact same companies in the exact same order as VOO. And you can see it's just slightly higher to 26.85% of total assets, but it's the same. I didn't mean to click on that. It's the same thing. Okay. Look at that. Same 3-year, same 5-year, same 10-year. It's about the same thing. So this is generally like apples to apples. But look at this. Look at this little difference here. It's the net expense ratio is a little bit higher. And now I can't exactly say why that is. I'm sure if I looked it up and figured out, I could figure out what's causing this to be a little bit higher. So let's look at how much that's going to cost us if we had $1,000 in stock. So we're going to take this percent and we're going to divide it by 100 and get the decimal, and then we're going to multiply it by 1,000, and let's see what that does. Haha, okay. So we are paying 90 cents every year for every $1,000 in this SPY stock, versus in comparison when we had the VOO, it was only 30 cents. So this is going to help you know how much are you paying in fees, because fees can really add up. You know, you want to keep more of your money. Now the dividend yield is a little bit higher. So you're getting a little bit more, even though this is a little bit more expensive. So let's see here. It's 1.5, almost $1.58. So let's multiply that by 4 quarters. So you're getting paid, the VOO is a little bit lower in dividends. You don't have to pay as much. This one's a little bit higher, but you're getting a little bit more money. So you just decide what you want to invest in and what you want to save up for. And then here, look at this. So this S&P fund was put into place in 1993. And so you can see it started off at $46 in 1994. That's almost 30 years ago. $40, and it's gone up. And then we had a crash. I think this was a tech crash. And then it went up, and then we had the real estate crash, and you can see what it does, and it corresponds to what's going on in the economy. And then look, up and up and up. And then look what happened. Look what happened. Can you guess what happened? 2020. This was the pandemic. And then look, it skyrocketed again. So it's the same data. If we took this same chart and we overlapped it with the VOO chart, it would show us the exact same thing because they both follow the S&P 500 index. They both follow this up here. Okay. Hopefully that helps. If you're ready to buy something, you can just hit buy. And it's going to take you to the purchase page where it's going to ask what you want to do, and you can sell, buy or sell. I don't do buy to cover. And then I'm going to put in one stock, and I'm not going to do the purchase. This isn't something that I want to purchase. And I just do market and good for day. And then I have the estimated total cost because this is the last price and they're expecting it to go up a little bit. So you're going to want to have a little bit more money. And I would say probably $420 maybe is what you're going to want to have, or $425. I like to have a little bit extra just in case. And then when you're ready, you can hit preview order or you can save it for later. So it's very, very simple. It's not as complicated, I think, as a lot of people make it out to be. Okay, so we're back in the watch list, but I want to show you a company that might not be doing so well. So something that I was interested in is real estate. And so there's these real estate investment trusts and these companies that will manage real estate. And this is one that I was looking at, and I'm actually not really excited about this one at all. And so I decided not to purchase this, but I thought it would be a good example to show you if this was something that you were interested in. This is NLY. It's Annaly Capital Management, Inc. And this is a really affordable investment here at $6.55. You really don't need a lot to get started, okay? And here's what I want to show you, something that could get you in trouble. And this is, I think, part of the risky part if you don't know what you're doing. And that's why I'm showing this to you. You could get yourself really excited seeing that you could earn 13% on your money. Now that is a lot. That is a huge, huge dividend yield. And what that means is that even though it's 22 cents, so let's get our calculator here. So 22 cents, and we're going to multiply that by 4. You're going to get 88 cents, and you're like, that is small potatoes. Why the heck would I buy this stock? But it's a huge percentage because you're getting 22 cents, but you only had to put up $6.55 to get 22 cents in return versus putting $300, $400 and only getting $1. Does that make sense? So you're putting up a lot less money. So if you bought, let's see here. If you bought $400 worth of this stock, okay, let's see how much that comes to. $6.55. So we're going to have 61 shares of this stock. And we're going to multiply it by 22 cents because you get 22 cents every quarter for each share. So you're getting $13 if you bought the equivalent of one VOO or one SPY. If you bought the equivalent, so you're buying 61 shares of this for what you would pay for one stock of VOO. So you're getting $13.43 every quarter. So every quarter, so we're going to multiply by 4. So you would get $53.72 maybe if they declare a quarterly yield. No, they don't have to declare quarterly yields, but we'll just assume that they're declaring a quarterly yield. So you're getting $53.72 if you bought 61 shares of this particular stock because the interest yield is so high. But here's what I want you to pay attention to. Don't get sucked into the trap of just looking at this and ignoring everything else, okay? This is what turned me kind of off, and this is why I wouldn't recommend this stock and why I don't own this stock. And again, I'm not a financial advisor. You can do whatever you want. But look what's going on. It's very volatile. It's going up and it's going down, and it's very just all over the place. But here's what I'm more interested in is what's been going on in the last couple of years. And you can see it's just going down and down and down and down and down. So unless there's something about this company that is revolutionizing the real estate industry, or, I think it's going to be around for a long time, or something else about it that draws me in, I'm not particularly interested in this as a long-term investment. And like for me in particular, I'm a long-term buy and hold kind of person. So like I said earlier, is that I don't really pay attention to this buying and holding and positive. I don't really care what everybody else says. I just do my own research on it. And so if you scroll down and look at, I don't pay attention to any of these either, but you can look at this on your own time. And then this just tells you what it is. Instead of it being over on this side where it said large, large stock, and what it says, it's over on the right hand side here this time. Let's look at another one real quick. And I think you'll recognize this company. It's Tesla. But you can see just by looking at this, if you don't know what you're doing and you're just looking at the interest rates, how it could be kind of deceiving and kind of misleading. And so you really have to be a wise investor, a savvy investor. You have to do your own research and don't buy something if you don't understand it. And that's the whole point. I really just wanted to get across to a lot of the newbies here is that I was once in your shoes and I had to learn all of this all by myself. And I'm still learning. I am not an expert by any means, but if I can help you get started, that makes me feel really good. So Tesla, so TSLA, you can see $864.51. It was double this at one point not too long ago. And look, no dividend yield. Look how interesting that is. So this is a company that's taking every single penny of anybody who's investing in this company and purchasing this company stock individually. They are taking this money and they're putting it back into their workforce, into their programs, into their equipment and machinery and technology, and they are growing the company. But you can see it was $47 in 2019 and it just shot through the roof. Everybody knows Tesla. It's a very strong company. It's a very trusted company. You can see all the analyst research says buy, buy, buy. Like I said, only do that if that's what you want to do. And we know that the majority of the stock is going to their automotive industry here. Same thing. It just tells you what it is, what they do. Here's their products. Super cool. But hopefully this gives you a lot of really good insight into investing, and it's not as scary. I'm really hoping that this gives you a lot more confidence. The last thing I want to talk about here is this dividend reinvestment, and it's actually called a DRIP, D-R-I-P. It's a dividend reinvestment plan. And what that does is every time you get a dividend payment, if you have, VOO and you got your dollar dividend for the quarter, what I would recommend any new investor to do is instead of getting that payout, you want to get to the point where your investments have grown so much that it's paying you enough to start doing things with that money. But if it's such a small amount in the beginning, you want to be taking that money and constantly just putting it right back into the stock every single time. You have to authorize that. So you have to go into this dividend reinvestment and you check a box and you say, yes, I want to keep reinvesting any dividend payment. It's really simple. You do it one time and then you don't have to do it ever again. And it should catch all of them, any investment that you have. And so number one, anytime you get a cash payment, it's going to create a taxable event. And so when I'm recommending to do the dividend reinvestment, you're actually pushing off having to pay taxes until the point where you're ready and you want to. Take that money and let it work for you, let it grow for you, and don't get discouraged at such a high dollar amount. I'm not sure if I said this, but even for me, I can't just every paycheck buy an entire stock. Sometimes I have to save up for it a little, a paycheck at a time and keep putting my money into my account, transferring money into my account, and then I buy it when I have enough. So don't be discouraged. Use this as kind of a benchmark. If you're feeling super confident and super comfortable and you feel so much better that someone has explained this to you, please put a comment below on if this helped you or not, or if there's, something in here that I didn't quite go over very well. If you want me to go over it again, let me know. But I really want to get you started, and I'm going to talk about why I think it is more risky and more dangerous not to be in the market, letting your money work for you while you're sleeping, while you're on vacation, while you're at work, because I just think it's really important. So keep watching. I'm going to have a lot more information after this, but I'm really sincerely hoping that this is getting you excited and making you want to go, I can do this. I can do this. And I know you can. I absolutely sincerely know that you can do this.
Literally, the only secret to accumulating wealth through investing is buying and holding. And that's it. Boo! Oh my gosh, okay. I'm sorry, I didn't mean to scare you. That should be the only thing that scares you in this video, not the actual investing part of it. If you got a lot out of that, please leave me a comment below letting me know if that was really helpful. I would really appreciate it. And while you're down there, please like this video so I can get this out to more people and help them with their financial education. I'm proud of you, and your future self is so proud of you. Something that might scare you is that we're going into a recession and the markets are starting to go down. And I will tell you that a savvy, smart investor is not worried about markets going down, and I'll tell you why. When a wealthy person goes and they're investing, they don't pull out of the market just because the market is going down. They invest more, and that's because everything's on sale. And that's the kind of mindset that I hope you have right now, is if you're thinking to yourself, well, should I be investing right now? It's not looking good. It seems scary. Yes, you absolutely should be investing right now if you're able to, if you have an emergency fund and your debt is kind of managed, because we are going into a recession. So I do want to make sure that you're financially okay before you start investing. But if you have the means to start investing right now, I do encourage you to do so, because you are buying it when it's at its cheapest. Now, most millionaires are made during recessions. I don't know if you knew that. I just found that out recently, and it completely makes sense. Wealthy people are waiting for opportunities like this when the market turns down and they can start buying things up on sale. It's like Black Friday investment stock wise. So don't let the downturn in the market scare you. Don't let the negativity and the media scare you. If you have a plan and you have a strategy, stick to it. A lot of people will say, just keep investing month after month after month after month. And I completely agree. Doesn't matter what the market's doing. As long as you're investing, you're going to be in good shape. Also, something else I was thinking is, if you are working for a company and you have a 401k, you're already investing and you might not even know it. If you have a 401k with your company, you had to go and pick when you were going to retire and put your money into this fund, like 2040, 2050, 2060. It's called target date retirement funds. And so if you're planning to retire in 2060, for example, you're taking all of your paychecks, and each paycheck you're putting a little bit towards this 2060 fund. So you might have already been investing and not even known it. Earlier, I had mentioned that the advice that you got about the stock market being risky and a gamble is wrong and possibly dangerous. So let me explain a little bit more about that. When I was doing a lot of my research, and I actually realized this not too long ago, is that the investment vehicles that we have nowadays, when you're putting your money into a savings account or even a CD and you think that you're making a little bit more money, you're actually not, because inflation is going up every single year. It just happens. We don't feel it in quite the same way because it's such a small amount that it goes up. It goes up about 4% every year. There's something called the Consumer Price Index, or CPI, and that's a measure of goods and services across the United States and how they look at the price that it was and the price that it is now, and then that's how they determine what inflation is. And so inflation goes up about 4% on average every year. Right now, we're feeling inflation at 9.1%, so it's more than doubled this past quarter. And it's squeezing all families here. And I know I feel it and you feel it. Every time you go to the gas pump, you feel it. Every time you go to the grocery store, you feel it. So on average, we're about at 9.1%. So if you think about where you're putting your money, and if you are trying to build for your future and put your retirement into a savings account at 1% or 2%, and you look at inflation every year is 4%. Now it's 9% right now. You are losing money every year because everything is getting more expensive by 4% or 9%. I did my own CPI study with my own area. Chicken cost $5.99 about a year ago. I keep my receipts. I know it's a weird thing. So I pulled up some old receipts and that's what I saw. Now I went to the grocery store recently and a pound of chicken was $6.99. And you might be thinking to yourself, it is just $1. Why does that even matter? When you calculate it in terms of percentages, that is a 16% increase in price from $5.99 to $6.99. And that's where you actually start to realize, like, wow, things are actually getting really expensive. So I don't know about you guys, but I don't have a 16% raise in my future. So if you're investing in the stock market, you can help get yourself to a little bit of a better situation. But on average, it's 9% across the board. We're not measuring everything based on the cost of chicken.
And this is what I'm talking about with inflation. If it's 9.1% inflation, or even in normal times around 4%, and you're getting a 10% return or an 11% return or 12% return, you are beating inflation and you're actually able to keep pace with and outpace what's going on with inflation so that you can keep more of your money.
But I do hope that's helping you understand why I'm saying it's so important to be invested in things that are not only safer for your money, but are working harder for you to help make you more money in the long run, to beat out inflation, because inflation is not going away. It's here to stay. It's here every year. And you just need something to help you keep more of your money. I just want it to rain money. So the last thing I want to talk to you about is Social Security. Now, Social Security, if you are working full-time like I am, you are putting money away for Social Security. You are funding actually the current retirees today. So it's complicated and I'm not going to go into too much about how that all works, but I'm just going to say that Social Security is not meant for anybody to live off of. It's not meant to fully support you in retirement, and it's not going to fully support you in retirement if you don't have other ways to save for your retirement besides Social Security. I'm considering Social Security like a bonus. I'm just hoping it'll still be there by the time I'm ready to retire, of course, but I am not depending on it at all. So what I'm seeing with the trends in Social Security, and I don't have a magic ball, I can't predict the future, but what I'm seeing is that not only are we living longer, so this fund has to sustain people for a longer period of time before they pass, but we also have less people working to fund this retirement fund. So I'm just kind of not going to depend on it, and hopefully you won't either, and it'll just be a nice bonus. And I did notice that they are increasing the age of when you can fully retire. It used to be 65 and then it went to 66 and now it's going to 67. So I'm anticipating that I won't be able to take full Social Security if it's still in existence until I'm about 70 is my thought process. The longer you can extend not taking Social Security, the more you'll get in your retirement when you actually need it the most. And you don't think about the things that you'll need when you retire. You may still have a house payment, you may still be paying for rent, and then healthcare. Healthcare is another one of those things that it's very expensive and you might need long-term care. And so how are you going to fund those things? You'll have to make sure that you are investing in your company stock, if that's an option. If you have a 401k, invest up into the company match would be number one, because they're giving you free money essentially. And then invest in your investments. And that should help build you wealth in 10, 20, 30 years, however long that you have left until you retire, so that you are completely confident and you feel really good and you can sleep at night and you know that you're going to be taken care of no matter what happens. Listen, you got this. I know you got this. You have it in you. I believe in you. And I hope that you feel more confident now going through this process with me. Now, like I said, I'm not a financial advisor and I can't tell you to do anything. I can just give you recommendations on what I would do for myself and what I would recommend to my family and my friends. But hopefully this gets you started. And like I said, don't feel bad if you have to save up a little bit here and there. If you are interested in making additional money, please go watch my other video about how to start a side hustle, things you need to consider if you're still working full-time. Financial education is a journey, and I'm really proud of you for taking these steps. Thank you as always so much for watching. I really appreciate you being here and I enjoy making these videos. Please subscribe if you'd like more content like this, and I will see you next week.
I was just making the chocolate cake for the video and it's mushed.
Say hi. Say hi. Uh-oh. And again. Get down, bud. Good boy. Thank you. Yeah, I actually have to clean my fridge. Here we go. Okay, we're ready. And what the heck does any of this have to do with chocolate cake? Well, we're gonna get into that right now. I am an finance passion, and yeah,